The Money Show. Personal finance.
So, have you recently bought a unit trust? If you've bought a unit trust, how did you choose that unit trust? And it's a serious question. Did you sort of go, eeny, meeny, I don't know. Most of us would ask a friend and say, like, what have you invested in? Or maybe you'd have a friend who's a financial advisor. You say, what should I invest in? And how does the financial advisor or the friend choose their unit trust? And I would suggest that many people go, well, let's see what did well last year. Let's see what did well the year before and the year before that. And let's see if there's any consistency. But last year, the guys who were hot last year, they've got to be hot this year. That's a good strategy, right, Warren Ingram from Galileo Capital?
No, it's a terrible strategy. And it's even worse when people look at it and say, so currently, if we look at what's going on in the South African, unit trust space, it's almost clear that over 1, 3, 5 years, and I haven't looked at 6-year numbers, but those don't generally get published as often. But over 1, 3, and 5, most likely the best performing unit trust in those timeframes is something that was generating interest. They would either be a money market fund or an income fund. And I don't want to name it because then everyone's going to go and buy it at possibly the worst possible time. So they're looking at that now and saying, gee, if I had moved my money from this balanced fund and I'd put it into this income fund.
Because balanced fund at best had been giving you 5% a year, at best, in recent years.
Yeah. And so, I should have had all my money in there. Why don't we do a switch now and let's put it into this income fund? It's delivering 8%. I mean, 8%, that's like double nearly what the balanced funds are giving. Let's just do that. And the world's uncertain. We should just do that. Let's, why don't we, that's a great strategy. And that conversation one hears more and more and more right now. And I can understand it much more than I could in the past, because any decent advisor would say to you, look, 5 years is a decent investment period. Over 5 years.
Hold on, let me just go onto my JSE app over here. Oh, look, the JSE has given you nothing in 5 years.
And so I understand investors who might have trusted their advisor over the last 5 years and by now are starting to say to themselves, hang on, you said long-term starts at 5 years, and actually, my JSE investment or my balanced fund, because I think most of the world ends up somehow in a mix of assets like a balanced fund, that they're not even beating inflation. So, sorry, I don't really buy your argument anymore. You've lost credibility with me, and I want to go into an income fund. And that's generally what happens. So either they choose the best fund in a particular category, but I think that's even a bit too scientific for what generally happens. Most of the time, people just look at what is the best performer they can find, and often it might be advertised. That's the scary part about this. Well,
again, this is a marketing game. If you're in the investment markets, investments are sold, not bought. So financial advisors go to conferences and to meetings, and they meet the fund managers, and the fund managers generally are quite warm, personable people, and they're smart and they tell a good story. And the ones that performed well last year say, I had the best performing unit trust last year. We had this amount of inflows and we're applying it in this way. This is the way we're going to do it into the future. And they go gobble, gobble, gobble. Yes, please. And then they go and sell their clients into those funds. And sometimes they get lucky. But based on history, you investing rather than based on what? Because I don't know how else you choose a great unit trust for the long term if you're not judging past performance.
So I think it's silly to disregard past performance altogether. I think that's a mistake that people make in the investment world. But they should use past performance as one of a few criteria, not just the only criteria. And I think that's the sad part about this. But if someone's sitting with me and saying, okay, how could I choose a unit trust? Write me like a 5-pointer or whatever, guidelines for how I can choose a unit trust. I think the first thing is, it's not, this is not like a marriage. In this instance, it is all about you. It starts with you first and what's important for you with this investment decision. And then from there you go. In other words, it starts with, what do you need this money for? And when do you need it? So if you need this money to be part of your long-term savings, and so, as we've established, 5 years and longer, then that's an important criteria, because it means you can afford, from a time point of view, you can afford to take some risk. In other words, you can afford to have some or most of the money in shares and in property. So that's an important criteria. The second thing will be, if we've got the time frame sorted out, then the second thing will be your innate tolerance for risk. As a human being, what sort of investment risk are you comfortable to deal with? Very hard thing to quantify. It's an extremely difficult conversation to have, because if you're starting out with investments, you don't know. And secondly, no human being likes to lose money. So,
and also, I don't know if they still do it, but I mean, if you go to financial advisors and they give you a test to test your risk tolerance, and you ask questions, and then you try and game the game, because you don't want to look stupid, so you start answering questions in a way that makes you look clever. And that doesn't give you a real risk tolerance at all.
No, and I mean, I can tell you, when I started in the industry, and that, it was only a year or two ago, maybe in the 90s, the questions used to ask things. One of the questions would be something like, do you participate in adrenaline sports? Do you do bungee jumping, or do you, as if somehow your tolerance for personal safety relates to your tolerance for investment risk.
And it's also the world's worst question, because I mean, bungee jumping relative to horse riding, I'm sure, is considerably safer. Because the people,
at least you've got a rope attached.
You've got a rope attached to you, and a horse thinks for itself, and if it doesn't like you, you're going to end up on your face.
Yeah.
So bungee jumping is probably a very safe thing. Yet it's deemed to be dangerous. Therefore, you like adrenaline. Therefore, you like high risk. Therefore, we're going to put you into some
small company funds in Southeast Asia.
Small company Bitcoin traders in Southeast Asia.
Yeah.
Yes.
So the thing there is that a good risk tolerance tool nowadays, there more and more of them have been developed over time, and they've actually started to involve proper psychometric tests. And so your comment there is right, though. Don't now try and fool somebody else, because all that's happening in that situation is you're going to compromise the advice that you're going to be given, and that's not a good outcome. You're not fooling anybody except yourself.
But I know that if I'm only putting away 1,000 rand a month, and I'm not going to have enough for retirement, so I want to take more risk. I want to be seen as somebody who can tolerate higher risk. So therefore, I'm going to go and fib on the test to make the advisor think that I'm a high risk candidate, because otherwise they're going to put me into an income fund, and I'm only going to make 7 or 8% a year, and that's not going to grow my money fast enough. And actually, I'm quite greedy, and I just want to make as much as quickly as possible.
Yeah, and I mean, what a fabulous way to make terrible investment decisions.
Yeah. No, but I think people do this kind of thing.
And I think that's the sad part, is that I think in something like this, a level of honesty, at least with yourself, in an exercise like this, is important, because the thing about risk tolerance is everything's fine until it's not. And so when you go through a big market drop like we saw in 2008, which from a drop point of view was a very big drop, but the recovery was very quick, you won't participate in that recovery if you actually have a low tolerance for risk, but you fibbed to yourself or to your advisor, and you participate in the loss. What happens is your instinct and your individual inbuilt drive will kick in. No matter what you do, it's hardwired in you. What will happen is you will at some point send a sell instruction either to the unit trust company directly or to your advisor, and there will be no discussion or negotiation. It will be an instruction. Get out. And then the advisor will be saying, if it's a decent advisor, hang on, just stick it out, and there won't be a debate. It will just be sheer panic, and you're going to tell them to get out, possibly the day before the market turns, because as a human race, that's what we do. We've seen this hundreds of times over now. So I think the thing there is to try and understand that. The third criteria when you're making these unit trust selections is your financial ability to deal with risk. In other words, if you're 25 and you're saving 1,000 rand a month, and you've got a long period of time to go before you're going to need this money, and you've got the tolerance sorted out, and you understand what's going on here, fine. Then do it. But if this is money that you need in a year's time, because that's when you're going to retire, then even if you've got a high tolerance for risk, but you might start to need the income from this, then you need to review your position. So your financial position is important, and it's probably as important as your tolerance for risk and the time frame that you're going to invest the money. That's the starting point for making a unit trust selection. What it will do is it will give you the category of unit trust you should be looking at. In other words, should it be pure shares? Very few people should have all their money only in shares. It's actually a very small percentage of the world's population. So most of the time it's going to be some kind of a balanced portfolio. It could be they're called the moderate funds or conservative funds, where you've got some exposure to shares, but it's quite a low exposure. Or it's going to be the balanced funds or something in between. Very few people should have all their money in cash or all their money in an income fund. even if that was the best category for the last year or two. And I'd probably say, especially if it was the best category for the last year or two, you definitely shouldn't have all your money in money market or fixed income or income funds. Because
But if you told me that 3 years ago, then because you don't put the money in the best category of the last 2 years, I wouldn't have put it into money market funds. And money market funds have continued to outperform for the next 3 years. So that
for the
would
last 3 years.
Yeah. From that point.
Yeah.
So none of this is set in stone. So I still don't know how to choose a unit trust.
I mean, we're nearly there, aren't we?
I hope so.
So then once we've got those categories, then to look at past performance is not a bad idea in that funds category. So let's just stay with balanced funds because it's an easy one.
Yep.
So you would say, okay, let's judge this balanced fund in comparison to its universe. What have other balanced funds done in over a longish period of time? Don't go and look at the last 1 and 2 and 3 years, because that frankly could be down to luck. So what you want to see is, does this fund deliver consistent performance? Is it in the top half at the very least, preferably in the top 25% of its performers and in its benchmark over 5, 10, 15 years? Important point here. I'm not really that interested in a fund that's only 1 or 2 or 3 years old, because it's not showing me a history of being able to deliver.
And what did they do when things went pear-shaped? How did they behave? And is it the same person who's managing that money today as was managing it 5, 6, 7, 10 years ago?
And I think that's the fact of the industry is that I'm pretty interested in companies and funds that have been around for a long period of time, and particularly where the founding group have retired, they've passed on their knowledge to the next group, and those people have implemented the philosophies and the approach in the same way as the past, and they've managed to do it consistently. Where that founder, is, let's say, elderly now, and that founder disappears, we have no guarantee that knowledge will move on. So it does work against the newer entrants. That is the sad thing. But what I would say is, if you're struggling to make this decision and you've decided balanced funds is your thing, history tells you you're probably better off choosing this year's worst performer for the next 5 years than this year's best performer. That's really the bottom line in this whole thing, is actually
But don't go and choose this year's worst performer, because it may be on its way out. I mean, the fund manager may have gone, the fund manager may have gone crazy. Again, understand it's the worst performer. Understand why it's the worst performer. Why did it do bad? Did you understand why they were buying property shares when property shares were on a steady decline? Do you understand what they're thinking? I mean, this starts getting really complicated. So you go to a financial advisor who went to lunch with the fund manager and they say, buy this, and you go, okay then. Because that's rough. That's actually what most people do.
And it's time to start asking questions, and it's time to start getting behind that first level of answer from the advisor or from whatever you've read or whatever it is that you're following, because that's not a good enough answer anymore.
I went to the presentation, we had lunch, and they were such a nice chap. So clever.
And that fund manager is telling me about all these wonderful things he wants to buy or has bought in his fund. That's not good enough either. But don't shy away from bad performers now. I think that some of the best fund managers in this country and actually in the world, Warren Buffett's a good example of this. I mean, he's a fund manager. And right now, they're not delivering great returns because the markets are skewed. Things are strange at the moment. But watch the next 5 years, and I bet you class is permanent. And I think that's what happens now. The classy managers start to deliver again when the world gets difficult, which is it must be the definition. And so now is not the time just to chop and change. If your potentially great fund that you've had that's been run by great managers is just near the bottom of the rankings, that may be, in a funny way, should be a source of comfort for you now.
Warren Ingram from Galileo Capital. How to choose a unit trust. It's a complicated thing. There are 1,000 something of these things. There are lots of them. And then you go into the exchange traded funds place and there are hundreds of them now too. It's becoming a very, very crowded marketplace.